The last thing to talk about with respect to shareholder distributions is stock repurchases. Firms repurchase shares as an alternative to dividends. Repurchases reduce the shares outstanding, often boosting earnings per share. They're flexible. They do not lock firms into ongoing commitments. This is a distribution, but it ends the ownership of the shares. So treasury stock is created. Treasury stock does not receive dividends. Treasury stock does not get to vote. So Apple has repurchased more than 600 billion of stock since 2012. It's the largest program in history. So repurchases can also signal that management believes the stock is undervalued. So what are the procedures? Obviously, the firm has to announce its intent to repurchase the shares. There's three ways this could happen. It could happen through an open market buyback. The company just buys it back from the stock market. It could result in something called a tender offer, where they would offer a certain price to current shareholders to relinquish their shares. We could also do something referred to as a targeted block repurchase, where we choose possibly one investor and ask that one investor to relinquish their shares. So how this happens, in this case, we have a company that's $1,937.50 in value. They have $50 in short-term investments. Through this process, they're going to recapitalize, essentially. They're going to buy back some stock. So they take the $50 in short-term investments and they buy back the shares of stock. Note that what happens is that the stock price drops by the dividend per share in the model. If it didn't, there would be arbitrage opportunities, assuming no taxes, for shareholders to take advantage of this. In the real world, stock price drops on average about 90% of the dividend itself. Mechanically, the firm's total value doesn't change. A dividend reduces cash and lowers share price by the dividend amount. A repurchase reduces shares outstanding while leaving the price unchanged. Shareholder wealth remains the same. However, perceptions can differ because of taxes, signals, and investor preferences. This is a signal. Why would managers buy back the stock? As investors do, managers will buy the stock if they think the value is too low. They have a good idea of what the value of the firm actually is, since they have all the inside information. So buying stock is a positive step if a person perceives an increase in value. So physically, or how does this actually happen? We need to figure out how many shares we're going to repurchase. So the number of shares repurchased, we take the number we had in the beginning and we subtract how many we have at the end. That tells us how many we actually repurchased. So the number of shares repurchased, also, we take the cash, the amount of dividend that we are going to distribute, divide that by the current price. So in this case, we had 100 shares prior. If you subtract from that the $50 repurchase amount, $50 million purchase amount, divided by $16 per share, we would buy back 3.125 million shares. That leaves us in the end with 96.875 million shares. In our example now, we see how this plays out. Here's our difference. The $50 went to the repurchase. The shares changed. But what that did is it didn't change the price. The price remained the same, but the shares repurchased, getting that 3.125, that goes to those older shareholders. Again, the short-term investments are used. In this case, the price of the stock does not change. So what are the key points? Short-term investments fall because they're used to repurchase. The stock price is unchanged by the actual repurchase. The value of equity falls from 1,600 to 1,550 because it no longer has the short-term investments. But the wealth of shareholders remains at 1,600 because shareholders now directly own the $50 that was previously held by the firm. So the shareholder wealth doesn't change, but shareholder ownership does change. That $50 represents the old value. Somebody owned those shares previous. So what's the difference between repurchases and dividends? In a repurchase, the stock price doesn't fall at the time of the repurchase. The number of shares falls. For dividends, the stock price falls by the amount of dividend at the time of payment. The number of shares doesn't change. So again, what are the advantages? Flexibility, the possible tax efficiency, a signal of undervaluation. What about dividend disadvantages? This could signal weak growth opportunities. Why don't they buy something else? Maybe they can't find anything that's profitable. It also might attract regulatory scrutiny. So again, dividends, by contrast, provide stability and appeal to income investors, but can commit firms to rigid payout levels. So again, just to kind of continue on, just to reiterate, right? What are the advantages to repurchases? Stockholders can choose to sell or not, right? This helps avoid a higher dividend level that might not be able to be maintained. Income received as capital gains rather than higher tax dividends. Now, this isn't really true now because they're both taxed the same. Stockholders might take this as a positive signal, and they think that stock is currently undervalued. On the disadvantage side, right, they could see this as a negative signal. They don't have poor investment opportunities. The IRS could impose penalties if repurchases were primarily to avoid taxes on dividends. Again, that statement comes from a time when dividends were taxed at a different tax rate than capital gains. Currently, they're the same tax rate. So another issue with recent increases in purchases is the impact on ratios. Apple has repurchased in dollar value more shares than the equity of the company. If a company has $10,000 in debt and $20,000 in equity, what happens to the debt equity ratio if they repurchase $10,000 in equity? It goes from 50% to 100%. If equity had $5,000 in common stock and $1,500 in retained earnings, what happens to equity? Equity actually would turn negative, especially if the stock value is increasing. So this plays havoc with some of our financial analysis of equity and the risks associated with borrowing. Final topic of discussion really is what's referred to as the stock dividends versus stock splits. Stock dividends is when a firm issues shares in lieu of paying a cash dividend. If you get 10%, you get 10 shares for every 100 shares you own. A stock split is when a firm increases the number of shares outstanding, say 2 for 1, and sends shareholders more shares. Now, both of these increase shares outstanding without changing value. A 2-for-1 split doubles the number of shares, but halves the price per share. Tesla's 2020 split drew attention and increased retail demand, even though the fundamental value was unchanged. So splits may be used to keep stock prices in an optimal trading range. This is often viewed positively by investors. Both stock dividends and splits increase the shares. The pie is just divided into smaller pieces. So unless the dividend or split conveys information or is accompanied by another event like higher dividends, the stock price falls so as to keep the investor's wealth unchanged. But again, as I mentioned, stock splits and dividends may be a strategy to keep our price in an optimal price range so that more investors can afford it. So why would companies, again, consider splitting stock, right? Distributions are central to corporate finance, and the choices we make depends on taxes, signaling, clientele effect, agency costs, and firm strategy. With respect to splitting, the idea is that there is an optimal price range between $20 and $80. Stock splits can be used to keep the price in this optimal range. Again, they generally occur when management is confident. So as stock splits can be interpreted as positive signals. Now, again, when you think about different models, Coca-Cola maintains stable dividends. Apple has massive repurchases. Microsoft uses a hybrid approach. Ultimately, shareholder wealth is tied to free cash flow, whether it's paid today or reinvested in tomorrow's growth. That's the end of the video discussion on distributions to shareholders.